Welcome back to the program, talking a little bit about some of the interesting data as you kind of look at where the markets are based upon the length of time where they have been in decline. One of the statistics we were sharing with you in the last break is this notion of being in a bear market, which obviously the current market meets that technical definition, because that definition is the market down 20% from its peak. And certainly that happened during the course of last year, down at 1.25%, and has yet to go on to set a higher high. So that then by economic and definitional standards means that you're still in that bear market sort of segment. But what is interesting, I think, from a timing perspective, is that, of course, bear markets don't last forever. Markets got a pretty good track record, 100%, of going on to set higher highs after each time it declines. And so what's interesting in terms of the data is that right now, the current bear market is actually the longest, running now 221 days, the longest on record over the course of the past 50 years. And I guess the reason that we're sharing that is that perhaps that might put things into perspective, right? Because the reality is that if markets have already significantly and substantially priced in some type of an economic decline, then the only question remains is, have they sort of fully priced it in, and when will said economic event occur? Well, obviously we won't know that until the future, but it would seem to us that that now is a great time to make sure that you are positioned properly. The notion of selling out and going away or just waiting it out on the sidelines doesn't really probably make sense, because most of the damage is done, right? So if that's the case, then maybe there's more opportunity in front than behind, particularly from an investing perspective. So not particularly a good time to just be kind of selling everything, going away, waiting it out, sitting on the sidelines. By the way, that's never a good strategy. We're going to talk a little bit more about that in this segment of why it makes sense to be a boring investor, and how that leads to investment success over time. So welcome on into the program. This, of course, is Dollars and Cents, one of Central Florida's longest running radio programs. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite platform of choice. When you get there, subscribe to us. That way you know when we upload new content on a regular basis. We do that about once a week or so. If you have any trouble finding our channel on your particular podcast platform, well, go to our website, Nelson Financial Planning, and you will see in the upper right-hand corner, or if you're looking at it on your phone, it's right there below the main line. You'll see a bunch of icons. Click on the one that looks most familiar to you, whether that is Spotify or Amazon or YouTube, whatever the case may be, and you'll get immediately connected over to our channel on that platform. My name, of course, Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning. So some of you may take offense to my next comment, but I think it bears repeating that, frankly, studies and headlines and reports continue to underscore that, sadly, the average investor is a bit of a knucklehead, okay? And the reason we say that is that if you think about the most popular strategies that are sort of current, right, over the course of the past couple of years, and how much they blow up, particularly when you get into more difficult times, right? Cryptocurrency would be kind of first on the list. Trying to time the market, buying the dips last year was not a good opportunity to try and do that. In fact, it was one of the worst years to try and engage in timing. If you thought that, the market's down, I'm going to just kind of keep buying more, there was certainly some data that suggested it was not a particularly good year for that. Buying individual stocks, particularly, is always a tricky proposition, but I think more so than ever before, it's become an even harder proposition because of social media, what your friends are saying, what you're seeing posted, all of that. Winds up sort of chasing something that maybe sounds interesting, right? Like space tourism. Like, that's really kind of cool, but you have no idea whether that's going to be profitable or how far out is it going to take before anything like that becomes profitable. And that also sort of undermines the lack of diversification when you're just sort of owning or investing in one company. Margin options, those are just not even places that you as an investor want to head. Margin, right? I'm going to borrow against my portfolio to buy more. Leveraging is never a good idea, particularly when it comes to investing. And then options, oftentimes people don't have any idea how those work and wind up getting hit with big losses, particularly if you have any level of market volatility. So those are kind of the flavors, right? Think about crypto and timing and buying individual stocks that don't make any money, margin options. I mean, those are all kind of, I guess the only way to say it, knucklehead choices in a word. It just pays to be boring. And I understand that that's not anything that you can post on social media or you can talk to your friends at a bar about, but the reality is that that's really kind of the key to success, right? What are some of those investing fundamentals, all of which sound really boring, really tried and true and boring? Be diversified, right? What does that mean? Not owning just one company, not owning a concentration, not having all of your eggs in one basket, being consistent. Another boring. Who wants to be consistent? Day in, day out, same thing. Ugh, boring. Reality is it's time in as an investor, not timing, that gets you the best possible return over time. Of course, to be consistent as well requires you to maybe ignore the posts and ignore the media a little bit more than what you might otherwise be doing. And then lastly, to sort of continue the trend of why it's good to be a boring investor. Well, a boring investor would sort of own something that they know what it is, right? This company makes something. I use it every day. It seems to me like they're making a profit on it. So I'm just going to own that rather than, back to my space tourism analogy, right? I'm going to own a space tourism company because I think that might be really awesome. Well, the problem is that old McDonald's is selling a bunch of burgers on every street corner. So maybe that's something better. Boring. Yeah, I get it. But at the end of the day, oftentimes being a boring investor will allow you to not be a knucklehead one and chase after some of the many things that have become incredibly popular over the course of the past few years. That list is very, very long. And it sounds easy. It's boring. But the reality is that they hold that those types of concepts, being consistent, being diversified, owning what you know, holds the key to long-term investing success. It's not hard if you stop and think about it. It's kind of boring, but it gets harder and harder, more and more, and against our more needed now, easily distracted human behavior. With that, we'll take a break. We'll return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning.